Let us go back in time for a second to 1980. Silver hit $50 an ounce back then. It was huge. But then, almost as fast as it went up, it crashed. I mean, it really dropped like 90% in just a few months. It was ugly. It bankrupted some of the richest investors in America at the time. Then fast forward to 2011. It happened again. It's got close to 50, hit $49.45 and wham, crashed 30% in just 5 days. It's billions of dollars in profits that only existed on paper just vanished. And, regular folks? Retail investors? They were the ones left holding the bag. And then, remember 2021? That army of Reddit investors. They tried to squeeze the price to the moon, getting everyone to buy at once in this big frenzy and ... Well, the whole thing just fizzled out in a couple of weeks, but right now, I'm recording this in December 2025, and silver just shattered every record in history. We are looking at $61.86 an ounce. That is not just a new high. We are in uncharted territory here. The old record was that $50 from back in 1980, which was, 45 years ago. But here is where things get absolutely insane. China is literally airlifting silver across continents right now. In October alone, they loaded 660 tons onto cargo planes flying from Shanghai to London. Why? Because the vaults are running dry. And on top of that, the Federal Reserve just cut interest rates today, which makes precious metals look even better to investors. So, naturally, social media is exploding. Everyone is predicting a silver squeeze, saying it's going to $80, $100, maybe even higher. If you had put 10 grand into silver back in January of this year, you'd be sitting on $19,000 right now. That is a 100% gain. It's not just beating the stock market. It is absolutely crushing gold, which is only up 56%. So, here is the question everyone is asking themselves. Is this just the boy who cried wolf again? Or, is the wolf actually here this time? 'Cause, look, I need to tell you something. I have seen this movie before, 3 times, actually. And let me tell you, every single time it ended in a total disaster. Until ... maybe now. That is what we need to figure out. Because whether you own any silver or not, what is happening in the commodity markets right now is going to affect your money in the months ahead. Now, this isn't financial advice, okay? This is education. But by the time we are done here, you will know exactly how to think about what is coming next. Let's dive in. Our story really starts in the 1970s with 3 brothers from Texas, Nelson Bunker Hunt, William Herbert Hunt, and Lamar Hunt. The economy back then, it was a total mess. Inflation was hitting 13.5%. You had gas lines, the Iranian Revolution, the Soviet invasion of Afghanistan. It was chaos everywhere. So the Hunt brothers looked at all this and decided, you know what? Paper money is doomed. We need silver. In 1973, they started buying it at just $3 an ounce. Which, seemed reasonable at first. But then it turned into something else entirely. Became an attempt to corner the entire market. By 1979, these guys controlled over 100 million ounces. That is roughly 1/3 of the global supply. Just think about the audacity of that for a second. 3 guys controlled more silver than most governments did. And here is what happened next. In January 1979, silver was at $6 an ounce. By January 1980, it hits $50. That is a 713% increase in just 12 months. Their paper fortune was in the billions. Tiffany & Co. was so mad about it that they actually took out a full-page ad in the New York Times just to condemn the hoarding. Then the regulators stepped in. The COMEX enacted something called Silver Rule 7, which restricted any new long positions. But the real collapse happened on March 27, 1980, a day that everyone remembers as Silver Thursday. See, the Hunts had been using massive leverage borrowed money to control their positions. When prices started falling, they faced margin calls they just couldn't meet. On March 27th, they failed to meet a $100 million margin call. And boom, the market imploded. In just 4 days, silver crashed over 50%. It went from $21 to under $11. The Hunt brothers lost $1.7 billion almost overnight. By 1988, they were convicted of market manipulation, fined $10 million each, banned from commodities trading for life, and had to file for bankruptcy. One of the largest bankruptcies in Texas history, actually. Silver itself, it crashed 90% from its peak. It fell all the way down to $4.90 by 1982. The lesson here? You cannot manipulate markets. No matter how much capital you have, when the scheme unwinds, it unwinds fast. Now, you might be thinking, okay, but that was 45 years ago. Surely we have learned something since then. No, we haven't. Fast forward to 2011. The world was still reeling from the 2008 financial crisis. The Fed was printing trillions in quantitative easing. Fears about inflation were rising. People thought the dollar was collapsing. Silver went from $30 to $49.45 in just 4 months. Everyone said, this time is different. We have real inflation. Then, on May 1st, 2011, it all fell apart. Silver crashed 30% in 5 days, down to $34. But it didn't stop there. Over the next 4 years, it fell all the way to $14. That is a 71% decline from the peak. If you bought at the top in 2011, you didn't see those prices again until 2024. That is a 13-year wait. The lesson there? Monetary policy alone isn't enough. If it is mostly speculation and not real demand, the collapse is swift. Now, 2021. This one is, even more pathetic, honestly. Reddit's Wall Street Bets had just squeezed GameStop from $20 to $500. Hedge funds lost billions. It was David beating Goliath. Emboldened by that, they turned to silver. Kay said, silver's the next GME. Silver squeeze. In January, silver was at $25. On February 1st, silver hits $30. That was an 8% surge in a single day. By February 2nd, it was back to 26. The squeeze fizzled out in days. Why? Because GameStop was a $2 billion market cap. Silver trades $150 trillion annually. It is just too big. The squeeze was hype without substance. The lesson: you cannot manufacture a squeeze through social media coordination alone. So, there you have it. Flow 1980, manipulation, 90% crash. 2011, speculation, 70% crash. 2021, social media hype, immediate failure. Which brings us back to today, December 2025. Silver is at all-time highs. Are we just repeating history? Or is something fundamentally different this time? Let's find out. Look at the duration of these rallies. 1980 lasted 2 years, driven by manipulation, and crashed 90%. 2011 lasted for months, driven by speculation, and crashed 70%. 2021 lasted days, driven by Reddit hype, and fizzled immediately. And now, 2025, 12 months. 1.11% gained, driven by an actual supply shortage. That is the difference. Every other time it was smoke and mirrors. This time, there is no silver in the vaults. Let me show you exactly what I mean. For the past 5 consecutive years, the global silver market has been in deficit. Demand has exceeded supply every single year since 2020. The numbers are staggering. The projected deficit for 2025 is between 149 and 215 million ounces. That is the largest single-year deficit on record. The 7-year cumulative deficit is over 1.2 billion ounces. Think about that for a second. More than 1 billion ounces of silver have been consumed beyond what was produced. Where did it come from? Existing stockpiles, vaults, reserves built up over decades. And those reserves are now running dangerously low. Meanwhile, mine production has declined by 1% year over year. And here is why that matters. Silver is primarily a byproduct of mining, copper, zinc, and lead. About 70% of silver comes from these operations, not dedicated silver mines. So when those base metal prices are low or mines shut down, silver production falls as a side effect. You can't just turn on silver production like a faucet. Opening new mines takes years. But here is the most important shift. And this is what makes 2025 completely different from 2011. Industrial demand now accounts IHE. Industrial demand now accounts. In 2011, it was only 50%. In 2011, it was only 50%. This isn't jewelry. This isn't investment speculation. This is the infrastructure of the 21st century economy, and there isn't enough silver to build it. Three forces are devouring silver faster than it can be produced. First, solar panels. 20% of all global silver, 200 million ounces going into solar this year alone. China produces over 90% of the world's solar panels, and they are installing them at an unprecedented rate. They are building enough solar capacity to cover an area the size of Texas. And here's the critical part. Once that silver is in a panel, it is effectively gone for 25 to 30 years. It is not economically viable to recycle silver from old panels at current prices. So this demand is cumulative. It keeps building year after year after year. Second, electric vehicles. Each EV uses 2 to 3 times more silver than a gas car. We are talking about 25 to 50 grams and various electrical components. Global EV sales are projected to hit 20 million units in 2025. That is hundreds of millions of ounces going into vehicles. Third, AI data centers. Every new AI training cluster, every new 5G tower, every new chip fabrication plant. They all require silver in circuit boards, antennas, server infrastructures, and connections. The AI boom isn't just happening on screens. It's happening in data centers packed with silver. This industrial demand is not speculative. It's not going away if sentiment shifts. Solar panels need to be built. EVs need to be manufactured. 5G networks need to be deployed. This is structural, persistent demand that cannot be easily substituted. There is no good replacement for silver in most of these applications that offers the same combination of electrical conductivity, thermal conductivity, and cost. This is real. Remember that airlift I mentioned? London's precious metals, vaults the global center for precious metals trading, were running critically low. To prevent a complete breakdown in their delivery system, they had to airlift massive quantities from China. I have covered commodity markets for years, and I have never seen anything like this. When the world's largest financial centers are cargo planing metal across continents in an emergency, that is not a bull market. That is a crisis. In November, there were reports of system strains at the CME during silver delivery notices. The market gapped up 5.53% the next day. Shanghai vaults have plummeted to their lowest level since 2015, draining 29 tons per week. The silver market has been in backwardation. That means people are paying more to get silver right now than to wait for future delivery. That is acute scarcity. That is panic. And here's the final piece. In 2023 and 2024, several governments, including the United States, designated silver as a critical mineral. It is essential to national security now. When governments start treating a commodity as strategically important, that is a fundamental shift. So let me summarize the core distinction between 2025 and all previous rallies. Previous rallies were driven by actions that could be reversed when sentiment shifted or regulators intervened. The 2025 rally is driven by a mathematical reality. Demand exceeds supply, and the deficit is structural. In 1980, 2011, and 2021, smart money was selling into the hype. taking profits from retail enthusiasm. In 2025, smart money is dealing with a procurement problem. Industrial users genuinely need the metal and are competing for limited supply. That is not hype. That is supply and demand. Now, before you think I am telling you to rush out and buy silver, let me pump the brakes hard. Because even fundamentally driven rallies can correct sharply. Even real supply deficits don't guarantee prices only go up. Silver is up 100% in 1 year. That is an enormous move. Even if the long-term trajectory is higher, a 15 to 20% pullback from $60 would take us back to $48 to $51. That wouldn't change the fundamental story, but it would be painful for anyone who bought near the top. Here are the 3 ways this could still blow up. Number 1, recession kills industrial demand. Remember, 60% of silver demand is industrial. The economy tanks, demand craters faster than supply can adjust. Solar panel installations get delayed as projects lose financing. EV sales decline as consumers tighten their belts. 5G buildouts get postponed as companies cut capital expenditures. In a deep recession, industrial demand destruction could overwhelm the supply deficit story. We have seen this before. In 2008, silver crashed from $20 to $9 as the financial crisis hit, despite long-term fundamentals. Number 2, regulators step in. Remember? Both 1980 and 2011 ended with rule changes. If banks holding short positions face serious stress, regulators will intervene with rule changes that force liquidation. It's happened before and it will happen again. Additionally, high prices cure supply shortages. At $60+ per ounce, silver mining becomes extremely profitable. This could incentivize the reopening of previously uneconomic mines and the expansion of existing operations. It takes time, typically 2 to 5 years. But if prices stay elevated, supply will respond. Number 3, you panic. Human psychology is powerful. A 20% correction from here will shake out everyone who bought on FOMO. Are you prepared to hold through that? Many investors who bought silver at $30 are now sitting on double their money. The temptation to take profits is enormous. If we see a rush for the exits, even temporary, it could trigger stop losses and create a self-reinforcing decline. And here is another risk. While the Fed cut rates today, they also signaled caution about future cuts. If inflation proves stickier than expected and the Fed has to hold rates higher for longer, or even hike again, that could strengthen the dollar and reduce precious metals' appeal. Fed. If history teaches us anything, it is this. From 1980, don't use leverage. The Hunt brothers borrowed heavily, and the leverage destroyed them. From 2011, watch for policy shifts. The crash was triggered by COMEX margin hikes and Fed signals. From 2021, hype does not equal fundamentals. Distinguish real supply demand from narrative. For 2025, good fundamentals do not equal no risk. Position sizing, timing, diversification. If you are right about the fundamentals, you can still lose money. Let's return to where we started. Is this the boy who cried wolf? Or is the wolf finally here? Based on everything we have, examine the current crisis. It's the 3 historical precedents. The fundamental analysis here is my assessment. This time, the fundamentals are real. The 2025 silver rally is driven by something the previous 3 were unt. A genuine multi-year structural supply deficit meeting unprecedented industrial demand. 1980 was an artificial shortage from manipulation, unsustainable. 2011 was speculation without supply, shortage unsustainable. 2021 was social media hype without fundamentals, unsustainable. 2025. Real deficit plus industrial demand. Sustainable but volatile. The wolf is real this time. The shortage is real. Industrial demand is real. The vault depletions are real. Attend, this is critical real doesn't mean risk-free. Just because the fundamentals support higher prices does UNT mean we unsee painful corrections along the way. Markets don't care about your cost basis. They don't care if you deserve to make money because you were right about the fundamentals. Even if silver reaches $80 or $90 by late 2026, the path there will likely include a 20% correction or two that shakes out weak hands and tests conviction. Remember, in 2008, during a fundamental bull market for gold, silver still crashed 50% before ultimately making new highs. Here is what sets 2025 apart. In 1980, 2011, and 2021, smart money was selling into the hype. Okay? In 2025, smart money isn't just selling. Okay? They are dealing with a real procurement problem. Industrial companies need silver for their production lines. They can't just wait it out. That is not hype. That is mathematics. You cannot manufacture 200 million ounces of silver for solar panels if there is UN2. 2 million ounces available. The laws of physics don't care about sentiment. So, what should you do? Here are the key indicators to watch. Shanghai inventory levels. If they keep dropping, that is bullish. If they rebuild, that is bearish. Solar panel production data from China. That is a leading indicator of industrial demand. Fed policy signals determines the monetary trajectory. COMEX registered inventories. Tracks physical metal available for delivery. And here's how to think about positioning. For long-term holders, if you believe the supply deficit thesis, volatility is noise. Consider dollar cost averaging. For traders, use tight stop losses, take profits on rallies, and don't fall in love with positions. For those on the sidelines, waiting for a pullback might be wise given the 100% rally. A correction to $48 to $52 would offer better risk-reward. I will leave you with one of the most important investment quotes of all time from economist John Maynard Keynes. Markets can stay irrational longer than you can stay solvent. The wolf might be real, but that doesn't mean you won't get bitten. If you are not careful, you can be right about the fundamentals and still lose money. If your timing is wrong, you are over-leveraged. You panic and sell at the bottom of a correction, or a short-term shock temporarily overwhelms the long-term thesis. The question isn't whether the supply crisis is real. It is. The question is whether you can handle the volatility on the way up. Because if history teaches us anything, it is that you can be right about where we are going and still lose everything on the journey. The wolf is here. Just don't let him eat you.